Observe this price action. Hitting a horizontal support line, it prints a massive green candle. To retail eyes, this appears as a high-probability long entry, but consecutive red candles immediately overwhelm buyers, dropping straight through support and triggering every stop-loss placed moments ago. Entering trades based on isolated candlestick shapes ignores the broader market context. Without considering where liquidity rests, these single candle signals often lead traders directly into institutional sell orders. Effective chart reading requires tracking the positioning of other market participants. By understanding how price interacts with structural zones and liquidity pools, we can identify why specific patterns consistently fail. On day one, sellers dominate higher levels, establishing a strong supply zone and a previous day low. On day two, the market opens and tests that level. A green bullish candle forms right at support. Pause and analyze. Which side holds the momentum? Anticipating a bounce, retail traders enter long, placing stop losses in a cluster below the swing low. Drawing a Fibonacci retracement reveals the true strength. Price rejects at the 0.38 line, failing to close above the 0.50 level. This 0.38 rejection indicates the bearish trend remains intact. Sellers resume the push, driving price through support and sweeping the liquidity resting at the retail stop-loss levels. The Fibonacci rejection confirms that the bounce resulted from early short sellers taking profits, rather than a genuine shift in market control. Without a close above the 0.50 level, the move remains a simple pullback within a larger downtrend. In this consolidation phase, price is bounded by a clear resistance ceiling and a tested support floor. A large bearish candle starts pushing below support. Expecting a breakdown, traders often enter short immediately, fearing the price will move away. Before the timer reaches zero, the price retracts, closing back inside the zone and leaving a long lower wick. Every trader who shorted during the candle formation is now trapped. Frustrated by the initial loss, many participants revenge trade the next red candle. This leads to a second sweep of their stops before the market reverses completely to target the seller liquidity resting above the resistance zone. Preempting a breakdown before the closing timer hits zero creates significant risk. A structural break remains unconfirmed until the candle body physically secures a close outside the zone. On this 15-minute time frame, the price respects a descending channel. As it touches the lower trend line, buyers defend the level, resulting in a pin bar that closes back within the channel boundaries. Zooming into the 5-minute chart for the same period shows a different picture. On this lower time frame, a bearish Marubozu candle has closed entirely below the trend line, signaling a confirmed breakdown to those watching only this view. Short positions initiated on the 5-minute close ignore the higher time frame defense. While the 5-minute trend appears broken, the institutional buyers are successfully holding the 15-minute structure. Aggressive buying follows immediately. The price rockets back into the channel, hitting the stop losses of the 5-minute breakout traders as the macro trend resumes its move. Breakouts on lower timeframes frequently fail when they occur inside a higher timeframe candle that has not yet closed. Validating structural moves on the time frame where the original trend was identified prevents entering into these macro liquidity sweeps. Methodical. To improve chart accuracy, apply these 3 standards. First, verify all potential reversals using the 0.50 Fibonacci level. A bounce that fails to cross this midpoint is a continuation signal, not a reversal. Second, require a physical candle close outside of consolidation zones before entering a breakout. Entering during the formation increases the likelihood of trading into a wick. Third, validate trendline breaks on the specific timeframe used to draw the structure. This ensures the macro defense of a level is visible before you commit capital. Sustainable trading requires moving beyond the visual patterns of individual candles. By identifying where impatient money is likely to be swept, you can align your entries with the actual flow of institutional liquidity.